Hello, friends. Welcome to another episode of Inspirations 9, the channel that leads you from finance, economics, and money to wealth. That is FEM to W. And I'm Sunil Thakkar. Today, let us discuss about $1 trillion question on people's, especially on the economists' mind, as to when will the US Fed start to cut interest rates. Well, despite the ongoing economic turbulence and the Fed maintaining that it will continue hiking interest rates, my long-term view is one of optimism on the gross domestic product, that is the GDP, and inflation. Although there is less than a 50% possibility of a recession in the short term, say in the next 12 months or so, once the Fed wins its battle against inflation, interest rates are bound to go southwards in order to boost economic growth. Let us now have a look at why interest rates have increased so much during 2022 and 2023. The Fed had increased interest rates to battle high inflation. It did this through the hike in federal funds rate and other instruments. Such was the hike that the 30-year mortgage rate touched 7% in November 2022. In fact, we have not seen such high interest rates since the global financial crisis, that is the GFC, in 2008. This increase in interest rates has hit consumers and businesses hard. Though housing prices have begun to fall, much of the US economy is still resilient to this hike. I believe one of the main reasons is that the households have saved much during COVID times, and this is keeping the inflation high, thus cushioning the impact of higher interest rates. Soon I expect the impact of this rate increase to spread to the other parts of the economy. This leads us to the main question. When will the interest rates begin to come down? Once the inflation comes down to around 2%, the Fed will resort to monetary easing to jumpstart the economy. So I believe towards the end of 2023, we should see a cut in federal funds rate. Inflation forecast. I believe by end 2023, the price spikes, which were caused by supply constraints of energy, consumer durables, and others, will ease, thus making the Fed's job of curtailing inflation easier. In fact, inflation could well be around 1.8% from 2024 to 2027, which at the moment is not in the Fed's perspective. Yes. Interest rate forecast. I expect the federal funds rate to drop to around 2% in about 2 years' time from now, which means the 30-year mortgage rate will fall to at least around 4% in 2025 rather than the average of 6.5% at present. For the interest rate to come down by the year end, a lot depends on inflation coming down too. Just in case, in the short term, if inflation does not ease, the Fed might be compelled to increase the interest rates to put the economy in a sharp and short-run recession. Once the rate starts to come down by end 2023, GDP will start its upward march during 24 and 25. Since housing prices remain a large part of the fluctuation of the GDP growth, lower rates in 24 and 25 will aid housing affordability due to lower mortgage rates and thereby providing the much needed oxygen to the ailing housing market. Lower interest rates will also be a welcome relief to investors. Rising rates played a major part in the sell-off on the bourses during 2022. Borrowers will also be happy that the federal funds funds rates are finally coming down, and 2025 will be a good time to negotiate mortgage rates for those who have, at present, borrowed at higher rates. Stock market might also benefit from these lower interest rates, and bonds will rally if yields fall in line with the above forecasts. Let us now look at another pertinent question as to how quickly will interest rates fall. Will the Fed do better than the Fed itself projects? I believe so, yes. Since the Fed started issuing multi-year projections for federal funds rate, many a time during the past 10 years, the Fed itself has veered from its path as it is compelled to adjust to the incoming data. The recent collapse of the two banks will not have any major impact on the monetary policy. The Fed eased liquidity to avoid any distress, but at the same time has kept a keen eye on the federal funds rate in 2023 in order to curtail inflation. So far, touch wood, this has worked well as the deposits outflow has certainly mellowed down after the massive outflows during March 2023. This is not anywhere near as bad as compared to the GFC crisis of 2008. Looking at the above, I expect inflation to come down quicker and eventually expect the Fed to cut the interest rates also earlier than what the Fed and other experts predict. When will the GDP growth accelerate then? Once the Fed starts easing the rates, GDP should show an upward trend by mid-2024. By 2027, the cumulative real GDP growth could be anywhere between 4 to 5%. The resolution of the supply constraints, the positive outlook towards labor market, and the overall improvement in productivity are reasons for this GDP growth. Which brings us to another question of when will inflation ease? The source of high inflation was due to the supply constraints of energy, consumer durables, and others. Once these constraints start to ease and combined with capacity expansion, shortages will turn into glut within the next few years. Along with these factors and a tight monetary policy, the inflation should be around 3.5% for the full 2023, down from last year's high of 6.2%. It should then average out to around 1.8% during 2024 to 2027. Let us now gaze into the crystal ball to see what is the US interest rate forecast. In the short term, the Fed plays a major role as it battles to bring down high inflation with higher interest rates. But in the long term, the Fed disappears from the scene. Other external factors take over then. Underlying currents in the economy, like the aging population, economic inequality, and slower growth, had all pushed down interest rates in the US earlier, thus leading to an excess of savings over investments, which means interest rates will remain low. These external factors have not vanished and will surface once the dust from the COVID settles. So friends, in my opinion, in the short term, a bit of turmoil might occur, but will be short-lived. And in the long term, for the reasons mentioned above, the interest rates will remain low. Well, my friend, that is it from me. I leave you on this positive note that not everything is doom and gloom. And shortly, we'll start a series on the understanding of certain financial terms which we hear in our daily lives, like inflation, budget, etc. And until we meet next time, please do not forget to subscribe, like this video, and stay inspired.